hourly Bitcoin dollar. So we have a key level of significance, as we call it. So I'm going to switch to writing mode and go straight to the pen. And the key level, we go little o of significance here, was basically your 6,400 mark. So see it over there, in essence. And then that becomes a left shoulder, which we've identified there. So you can see it. And then the grind line that it broke, there's your capitulation. This was all part of a falling wedge, by the way. So you can see the falling wedge. Here, these lines here that I've drawn. I also always split the wedge in its midpoint. I find that very, very useful for centering. You see that sort of cramps up that price behavior between the low and the high. And then you also had the funnel zone that we've covered before. No time calming you with the classical music in the background here, just so that you don't stress about your Bitcoin performance. We highlight that zone. That was a funnel zone. And what did you get as an outcome of that? Well, it's changed color, and let's go to the orange. You get your look one way, go the other way candle. So the first move is actually down, and then it gets properly rejected in this zone here, and it pumps right the way up. That was a key rejection. So that becomes a key rejection at the support level. But in fairness, as we probably said at the time, there wasn't much follow through initially. And in fact, there was a bit of a revisit. Once again, support at that key highlighted zone. Then you started to get the grinding up here. And there was some evidence of the selling in the tall wicks across there. So you were getting your squeeze, and squeeze, with the price behavior coming up under and below. Then when you did push out, you pushed out to that same key level of significance. Let's go back here. Let's even do it highlighted in red. That same key level of significance, which we've identified as the 6.4. And you can see how those upper wicks were taken on by that. So I'll go to the gray there. Push back there, push back there. But then we got, and this was very, very critical, what we call the low volatility price behavior with a slight tip of the hand drift upside. Now, I'm suspicious of that because it could also be, it's difficult to know directionally what's going to happen. So you almost have to focus at this key level of significance and treat it as what we call the sort of sniper point, where you are all concentrating. I wasn't that good because I saw all that and I was looking the other way. Time to clear and wipe the face a little bit of this chart, so I'm going to erase all. That key point was very, very critical. Listen to the drama of the classical music warning you. So here you have that push up in volume, but first you had the test of the level and the feign back in. Test, feign back in. That was a key warning. What on the shorter time frame you actually have is a small HVF in there, and it's all winding up at a key level of significance that we've already identified for you. The subsequent big push in volume, you kind of wanted to go with this because whatever happened here is going to be an impulsive move. It's decision time. Once again, just re-putting in the highlighted zone. This is decision time for this. Is it a legit reversal pattern, or is it just going to be another fallback? Remember, we've had before reversal patterns that haven't gone and done the full reversal. But this one, you could see that it did. You got your spurt. Look how quickly it makes it to target. So we talk about line of efficiency in HVF method. And that's the incredibly efficient line that takes you from your entry into the trade. You would have been a bit nervous there to the point that you are exited. And that's your target. And this gradient is a very, very steep gradient. In other words, time in trade equals X along your x-axis, and gain is y. The whole idea is get that Pythagoras line, that hypotenuse, as strong and as steep ascendingly as possible. So time on risk is low. Time on risk, reward to risk ratio is high, is big, and it's a lot bigger than is typical, and your time on risk is super small, it's even smaller than small. How about that? And that, of course, gives you the steep triangle. So it brings us to the fact that we are, as a trading technology, HVF method, the only trading group that I know that measures risk-reward ratio and time in trade divided by time. And incredibly short time frames. We also have time stops for if something is decaying. Incredibly short time frames obviously increase. So if it's less than one full unit, it actually increases the valuation that we consider that trade, because you get your capital back, you get your big reward back. Remember your risk, let's go to the red. Initially, you could have set just below there. In fact, I didn't change it to red, so let's do that. Risk should be in red. It should just be below that. Whoops, we don't want the highlighter though. We want the pen. Let's try that one more time. We might need to just get the eraser and take that off. One more time. That's the stop. You also have a round number that you're at, 63.30. So you can say, come and get me on the other side of that fence if you're prepared to jump me. As you get the feign and break, and it's called a triggering HVF at that point there, you can actually bring your stop up to your low 2 or your low 3. So your risk area is going to be not much more than this colored area over here. We can put another line in, roughly risk. But the gain potential is, if we change color, is going to be a lot more sexy for you. It's all this area all the way from your entry point. And this is the game. How much green can you get for as little red on the table? And that's your risk reward ratio that you ended up getting, and that is the direction to your target. We call the line of efficiency. You'll learn a lot more about that in that. Now the question for many is, what happens now? So that's all retrospective. You needed to be watching this at the point that it was happening, and it was a key moment, and I wasn't. This was another key moment where I was fortunate enough to be watching it, and I did get a reasonable amount of short benefit and a slightly smaller bit in the second stage of the move after taking off in here. Now the key point is, what's here? Well, you've just run a key target. And what tends to happen is progress decay. So wild pullbacks and maybe some gain, maybe not, but a lot more choppy instead of the single-minded steep line in your favor. Again, we're starting to make this a bit busy, so I'm going to trim it away and do an erase all. So what comes next? You've got this key level, the other key level that is huge. I've called it the 6775. You want to be early. Many are going 6.8. They're lazy. 6775. It's okay. It's $25. What's he being so smart ass about? It must be a key level of significance that's been tested and run. So 675 is the one for me right there. And what's happening? We're getting a little bit of pushback, and you've just made a target, so this can stall and decay. However, on the bigger time frame, if I can get that, I might have to just go out of drawing mode. Bear with me. Nope. Await that reload. So I've gone into tablet mode so I can draw a bit better. And we showcasing some of the new tools that I'm using in my premium area that I'll be commencing using. Actually, I'm getting myself trained up and actually practicing. So I'm killing a number of birds with one stone in essence. Let's go up to the 4 hourly so we can test that better. So you can see the existing draws. So now now you might notice if we go back into the drawing mode, how this leave. Yeah, let's leave. Now I want to show you how this point here was actually a mini fractal of the larger position we find ourselves in. This was your left shoulder, your right, your head, and your right shoulder there, with your key level of significance running through there, 6,400 already discussed. Let's take that away, but that's just a reminder now on the bigger time frame. Now you can see why I say the 6775, which we've had defined a number of times before, and we actually have a red line there from a historical stop on a funnel. So if you see where I've drawn, that is your 6775 that I was showing you. And we take it away again. Where does this come from? It comes from a funnel level that was a downside setup structure. So typically I color those in bare colors like pinks and reds. So that was that whole funnel area that was a downside structure. So you've got heavy, muddy fields for the cavalry to cross here. And that's why it's respected it so many times. In fact, my apologies, it wasn't a downside. You see the green line here, and that was a red line. It was, in fact, an upside. So the red line is always stop. And I'm going to go back to pen mode because that's a bit fat. And the green line is always go. So it was a long that was sitting on here. And before I clear this, wipe the face again one more time, let's just remind you how many times this has proven significance. Key levels of significance. There's a bit of a wind blowing and I'm sitting outside by the pool, so bear with me. Key levels of significance are usually smashed with volume and with impulsive movements. So this was respected as support for many times on bigger time frames. Go view it. Then after smashing it, you rally back into it and you find resistance. Then you go again, you rally back into it and you find resistance and you roll over. Then you grind either in the wedge and then you fail out and you try one more time, or if you look at it in a channel sense, you grind and again you have that big second resistance when it should have been, let's change color, it should have been, let's do it in dark blue, should have been your pump, pullback and bull flag to get you across the muddy river over here to the other side. It did part thereof, but then did the look one way per candle. It started a pump that was all green, and that was a key moment. It was also on the bottom of that wedge. That was where we got some more shorts on and we benefited. So you're covering all of this again. So here we are again, key level of significance. So in the same way I said, that is a sniper moment where you have to be at high concentration because you're going to get your clues as to direction, and you might get a look one way, go the other way canvas. You've got to hold on and check that because you first got a little feign and break, then it dummied back in. You might have thought that was going to sell off. You have to wait and watch and wait until the big volume has come. Very quickly, you'll see this is average volume here, this orange line that's running here. It's giving you the average volume. You would have very quickly surpassed average volume very early in this move. So by the time you might have been here, you already might have had a histogram there, or at least there, past the average volume which was there. So we're looking in a micro sense over here, and you can tell from the OBV bump as well that you're getting confirming volume on that. So at that point you don't argue with it. It first had the feign and then it pulled back. We're going to have a similar situation. This mini fractal is your dry run for a much bigger potential setup. Dry run for here. That's what's coming next. Here is the next sniper moment. That is it right here, going down 6775. Be early. If everyone else is 68, be early. Recognize it early. Because by the time it's pumping and they chasing, what kind of execution are you getting? What kind of execution will you get, do you think, when that happens? This is the variety I'm thinking. The brown stuff, and you don't want to be there. So make sure you get in early if it's to be. But the danger of that is you get your feign and then you get your pullback candle. And just because it's done it once doesn't mean it's given you a written guarantee that it doesn't have a failure point. All reversals don't necessarily reverse. Remember that. And also remember that on the bigger time frames, we're still technically in an inverted structure where the daily time frame can be determined as being bearish. So yeah, tell me if you like this new form of editing and vids and whether it helps. Something I liked about this, I should have done this more on the lower time frames when we're there, is that when I do my subsector divisor of that channel, you were sitting in the top half here and you were supporting in it. You're in the bottom, you're in the top, you're in the bottom, you're in the top, as you were squeezing into this little ascending wedge. So it was showing you a bit of strength. Have a look at that again and see it again. I really wish I was paying more attention. The key game about trading is not more trades. That is a big no-no. Once again, it's going to be counterproductive and down. It's actually being properly focused at the key moments when you get a fast moving piece of momentum that takes you very quickly away from a tight stop at a low volatility point. Low volatility, fast move. Low volatility right there, as I showed you on the higher time. Fast move, quickly taken target. You're comfy, you're in the zone, and now you wait to see what the market will do next. So I did mention that this was a deeper right shoulder. It's got a larger area. So if I just go to highlighter mode, below your key level of significance, it's got quite a larger area, and it was super high sell-off on the downside. This was super high sell-off, but grindy on the upside. So it was letting on. But this pump here that we've subsequently attained has in fact actually countervailed that steep sell-off as well. And it's coming back up as fast there. That candle is approximately the same as this one. This one has countervailed it to a large degree. So there has been a slight swap in the momentum. Let's see now. Let's see how it goes. Not high number of trades, low number of high quality trades with full commitment in a sized fashion. Low number of trades at key moments, tight stop, allowing full commitment, and not diversification principle where you're trading it on Ethereum and you're trading it on every under the sun and you're bragging about how low your risk is. It's only 0.5%, but actually they're all correlated. Take a real risk if you've done your research and it justifies it, but don't be having 5 trades on. It must be your primary trade and your primary piece of action. Low number of high quality trades is what you're looking for with tight stops. Each one of those are key points. Low number, high quality, which is tight stops, expansive risk rewards with the T element. They do it fast, aka breakout traders, fast moves in short times. How big could this one be? Well, you've got to look at the target again. You've got to look at the target that is being potentially on offer here, and that's going to require me to draw the full, and I'm not sure I've got enough space here. Will I be able to? That's in draw mode. I'm going to get out of draw mode one more time and say no, we don't want to save those changes. That's a 5-year-old scribbly mess that we're seeing there, but hopefully it's an interesting and useful one for you as a trader. While we wait for the platform to load in tablet mode, so it might dawdle for a bit. Let's do this. Let's try pull the scaling down, and I'm going to calculate the potential target for you in this setup on the bigger time frame. I think we're going to need that 4-hour back. In fact, let's go, let's stay with a 4-hour. I don't want to get too big. We'll stay with a 4-hour, but we'll rescale along here. Let's see where, if you got a repetition of that fractals event, it might go. So pull the chart a bit down, and let's see, maybe still a little bit more scaling required. So the targeting that HVF method uses, quite simple. We only look at horizontal lines that have clearly been run. This red line is, without doubt for me, my key level of significance. And it is the 6775 if we go back to draw mode. So we're going to leave. We go back to draw mode. We're going to go back to reminding you about that level. So how's the target? Quite simply, that is your low point. That'll be your line. And essentially that same space will be projected upwards, which would take you through that line over there. So those distances are roughly the same. So your overall target will invalidate the macro stop. So remember, this red and that green line is part of that daily bearishness. So once again, getting the highlighter out, this is all deep, thick mud. That's the stop for the inverted HVF we've been talking about, that has all the crazy low targets. I have said treat it with circumspection, because because he says we already have had a 70% adjustment. And to get such a super macro chart, we have things like that on Deutsche Bank, for example, really big super macros that give negative targets. On Litecoin, the same structure, because there was a similarity, also giving negative targets. You clearly can't trade a negative. So market geometry is an absolute awesome concept. But there are points where it will become meaningless. So post this didn't run to zero, but the targets we were getting on Bitcoin were down at 1500, 1600, and the second interims. They could have happened. They still could have happened. That's not a withdrawal method. Will allow you. You cannot trade your belief systems about markets. Trade the markets itself. Things you don't think will happen will happen. I never thought oil would trade lower than the 2008 low after being in the 130s, but it did. We got out too soon on the short side. And the exact same thing could apply here. But for now, it's all about the bullish situation with that move up to there, now replicating in length, which would get you out there. Let's go back to the proper pen, and you'll be talking in and around 700-800. By the way, the 8,000 level, not very far away from this potential target as well. So that could be quite a big return to form for Bitcoin. Once again, this is not a prediction. This is not a prediction. We have to watch what happens here. How does it cope? Will it have a cup and saucer on a smaller scale level with a smaller little pullback and then wind up to take it on? Or could it get a nasty little spanking, have a look one way, go the other way candle? You could be watching your key moment like a sniper, and it starts to get you in, which is the trickiest thing the market can sometimes do. That can all be green as a candle. Let's take him off and go to green. And then next thing you know, it turns into one of those. Can be all green candle, triggery, all love and light on reasonable volume, and then suddenly you can get a spank down. So that's the little ambush trick that can happen, like a bull trap. But once it crosses reasonably and the volume for me is gone through average, with still plenty time to go. In other words, you're clearly going to have an outlier on volume. I would go with the direction that the market is then accepted. Okay, hope that's useful for you. A couple of new tools. Less is more. Key takeouts for you. Less is more. Less trading, more key event notice trading. Being early to the trade, 675, I remind you again, key level, and always focus on RRT. How tight can you justifiably get that stop that the market has proven is a key level of significance? In other words, the horse is going to have to jump over that hedge to come and fetch you. So put the obstacles in the way, but how close can you get it so that you can reduce risk? So that's the risk that should be in red. Reduce that risk area, and then we get back to the green, expansive gain if we run that target, which could even go a tad more and give you the 8,000 number, which would be a key level. That would be very bullish for Bitcoin. Remember, however, the daily is still in a zone that could be moderately bearish. So it could exhaust at these levels. There's big funnels. I've shown this already, and this is a big funnel. This would be essentially a late second chance to that bearish entry. Could exhaust immensely. So lots of scribbling. I'll try to learn to do it better. I'm holding with one hand and having to write with the other, so the writing is not the best, but thanks for bearing with me. I hope you enjoyed the clip, and we'll be looking to do more of these in our premium areas, and I might occasionally do Freeview for that if that was helpful for you. It's not for everybody trading, but you can find out more at the 3 W's, which you all know about, and then you go to themarketsniper.com. Free webinar at the end of the month. That's the 31st of July. And there will be others typically on it's not what you make. It's not what you make, it's what you keep. Keeping is greater than making. Many can make. Wrong way around. Jeez, I'm just showing my dyslexia today. Making is smaller than that what you keep. Keep is the most important thing to value. So there you go. The scribbling ends here. Speak to you all later. Enjoy, and I'll speak to you later on in the week.